With more tariffs on the way, US stock prices continue to slide. So far this year, the Dow Jones has fallen 6% and the Nasdaq 10%. Despite the establishment of a US strategic reserve for Bitcoin, crypto is having a bad year too, a shortage of liquidity causing Bitcoin to fall 20% and others even more. Trump's first term saw a stock market boom. So far, it's more of a stock market slump. There's a clear divergence between the US and the rest of the world. US stock markets have fallen, but global stock markets, especially Europe and Germany, have done better than expected, at least so far. Don't forget, at the start of the year, US share prices were overvalued on the metric of price to earnings. There was a belief in US exceptionalism, the idea that the US economy, US firms were going to do much better. But now, US economic growth has been downgraded, and there are fears that the US troubles could spill over into the rest of the global economy. 2025 certainly seeing unprecedented uncertainty. Frequent changes in tariffs are spooking markets. The volatility index has climbed to levels reminiscent of the COVID pandemic. And this volatility will cause firms to think twice about investing, and consumers will be more nervous about spending. Already consumer sentiment is turning negative as an expectation of higher prices from tariffs is leading to falling spending. In recent years, the US has seen really quite good levels of economic growth, but this has partly been due to a fall in the savings ratio, high government deficit, rising levels of credit, and a boom in stock prices and assets like housing. US growth has also become dependent on the top wealthy 10%, but now with tariffs becoming a reality, federal spending cuts, a stock market wobble, and a decline in consumer confidence, the likelihood of a recession has started to increase. The concern is that fears over the future of the economy could become self-fulfilling, causing lower investment and lower spending. Yesterday, tariffs on Canada were temporarily doubled to 50%. But as is often the case, these tariffs were short-lived. But overall, the new wave of tariffs on Canada, China and Europe are likely to be more long-lasting, with both trading blocs threatening to retaliate. After their initial enthusiasm, investors are starting to pivot towards pessimism and re-evaluating the prospects of economic growth. The logic of tariffs on Canada is that Canada runs a consistent trade surplus with the US, but this is largely due to energy imports. The biggest supplier of foreign oil to the US is not Saudi Arabia, as you might assume, but actually Canada, producing 61% of US oil, and also, of course, many vital commodities too. Tariffs on Canada would have a big impact on raising prices of fuel, especially farmers in the north. Now, one big logic for tariffs is it will help bring manufacturing back to the United States. Since the early 1970s, steel production has fallen quite dramatically, and this mirrors a kind of a general decline in manufacturing and manufacturing jobs. The hollowing out of the US manufacturing base did lead to real problems in America's so-called Rust Belt, higher unemployment, a fall in real wages. But will tariffs be able to turn the clock back? In 2018, Trump imposed steel tariffs of 25%. Steel prices rose 5%, aluminium rose 10%. But there was no reversal in the decade-long decline. Now, if we zoom in, we can see a small uptick in production and a small growth in employment, but it is marginal at best. But of course, it doesn't stop there. Tariffs have knock-on effects for other industries which use steel and aluminium. Construction and manufacturing all saw higher costs, and their growth was adversely affected. And don't forget that it also leads to retaliation. US farmers were hit by retaliation from Europe and China. But 2018 was really quite mild. In the bigger scheme of things, it had a little overall effect on the economy. But the new wave of tariffs is really quite dramatic. It could take us back to levels of tariffs last seen in the 1930s in the Great Depression. Now, tariffs will increase prices of some goods, but it won't cause the runaway kind of inflation we saw in 2022 when oil prices surged. It's more likely to cause stagnation, which in a way is kind of worse, The real incomes of business and consumers will be reduced because they're having to spend more on imports, and so therefore there's less to spend elsewhere in the economy. In fact, economists like to joke that tariffs raise prices, increase inefficiency, reduce real wages, higher inflation, and lead to lower economic growth. But apart from that, they're really good. Now, that's not actually true. There can be a logic to tariffs. If you're a developing economy trying to diversify away from primary products, tariffs can play a role. And for the US, there is actually a case to raise tariffs on China for two reasons. Firstly, China has been offering unfair government subsidies to industry, which is giving them an unfair advantage, leading to this big surplus in things like steel. And secondly, there is a risk of a geopolitical conflict, and if you rely on importing from China, it may be an issue down the line. But if you do want to de-risk from China, if you do want to move away from a reliance on importing from China, one part of the solution would be to make use of importing from Mexico, which can offer low labour cost manufacturing. And this is why a publication like the Wall Street Journal is bemused by a tariff war on America's closest and friendliest neighbours. Now, the overriding logic of tariffs is to bring everything back to be produced in the United States. But this really reflects a world more reminiscent of the 1890s rather than the 2020s. Every car that is made in the United States has both components and raw materials from both Mexico and Canada. Tariffs would massively increase the cost of making a car because parts go back and forth across the border. Automakers warn that car prices could rise 25%. Now, in response to all these tariffs, car firms could try to bring everything back and make everything in the United States. But this would be incredibly expensive and time-consuming. Studies suggest the US would need to increase its capacity by 75% and would cost in the region of $50 billion. Now, this kind of investment is high risk. And the thing is, who wants to do it when there's no guarantee what is going to happen to tariffs in the future? Tariffs of 25% on steel probably won't be there in 2, 4, 8 years' time. They may not even be there next month. Nobody really knows. But when you have this uncertainty, you don't want massive changes in the nature of your business. The global economy is too integrated. It's very hard to unpick. What's probably going to happen is that actually firms cut back on investment, try to wait to see what happens. Now, if you did actually manage to bring everything back to be producing in the United States, it would simply be more expensive. If America tries to produce everything itself, it can't benefit from specialization and lower costs elsewhere in the world. And it could get darker for the American economy. There's already been a change in attitudes to American goods. Canadians are boycotting US goods. Europe is planning retaliatory tariffs. So is China. Consumers are boycotting firms like Tesla. And the net effect is lower trade, lower investment, and lower economic growth. So the big question is, does this mean the world is going to sink back into a kind of 1930s Great Depression, like after the Wall Street crash of 1929? Well, on this front, there are at least some good news. Firstly, oil and gas prices have been falling, which would help to reduce the stubborn inflation that still hangs around. Secondly, if the US economy does slow down, you can expect a strong response from monetary policy. You can expect to see US interest rates fall sharply, and the US respond with probably more quantitative easing, increasing the money supply to buy bonds. And I won't be surprised if this was used to finance the rapidly increasing level of US debt. Lower interest rates would of course help the beleaguered housing market, help consumers with debt, may even encourage investment. But it would mark a big shift in US policy to the dollar. Since the mid-1990s, US has really run a strong dollar policy, and this makes US imports cheaper, improves the living standards of consumers. It also encourages foreigners to buy US bonds and US shares. So if the US persists with tariffs, and if it leads to lower growth and we get lower interest rates, then it could lead to a change in the fortunes of a dollar. We could start to see a weaker dollar, especially since the administration often suggests they like the idea of a weaker dollar. Because a weaker dollar would have some advantages For the United States, it will make manufacturing more competitive, and it should help boost US exports. But it would also have disadvantages: high prices, less imports, relatively higher bond yields, less demand for US assets like US treasuries. And don't forget, the US debt is set to soar in the coming years, and if you don't get foreigners buying the debt, it might create more problems down the line. But having said all that, can monetary policy really solve the problems of some kind of economic downturn? Don't forget, in 2009, interest rates were cut to almost zero, but they did very little to prevent a deep recession and an ongoing financial crisis. The US economy has potentially many more problems than just falling demand. There's been growth in debt, growth in risk-taking, and a new wave of financial assets from meme coins to leveraged shares and derivatives. I haven't really had time in this video to go into all that underbelly of the US financial system. Quite hard to actually get a grip on it. This video spends a bit more time looking at some of the other systemic risks that could undermine the US economy in the coming year or two. Thanks for watching. Do subscribe, and there'll be more videos coming fairly soon. Lots of news happening at the moment, nothing short to talk about.